Alrighty, y'all. Welcome to the second weekly real estate roundup with myself, Bill Clifford, and partner here, Mr. Ray Gutierrez.
Hello, everybody. Howdy. Happy Friday.
That's right. Happy Friday. Let's crack that whip and get this thing going. All right. So I think today we're going to jump right into the interest rates because this week the rates went up and they've been going up for a few weeks now, which is obviously a bummer. It makes it difficult for anyone who's shopping for a home. You see some people who are kind of on that borderline where they're qualified for a payment up to a certain amount. And if the interest rate goes up, now that affects how much they can qualify for. So rising rates pulls a lot of people out of the market. And obviously it's just not ideal. Everybody wants a lower interest rate. This week we are approaching 7% on a standard 30-year fixed loan for somebody with good credit, and decent down payment, and all of those things. So that obviously is not that cool, considering we were down around 5.5% early in February. So
yeah, it's a big jump in a short amount of time.
It is, yeah. It's been moving pretty rapidly, and back in November, that was where we got up to 7.25, and that was the peak. As high as it's been for 20 years.
Right.
And then I think 5.5 is about as low as it got. So we're vacillating in that range. And it really all comes down to what's going on with the Federal Reserve and inflation. Obviously, inflation is the biggest factor when it comes to interest rates. And what's happening now is the Federal Reserve, the reason they're raising their rate is to try and curb inflation. So the other factor in that is, hold on one second. Get out of here.
Sure. It's interesting.
Okay.
How the jobs report affects inflation, right?
Yeah.
People hear oh, hey, there was a great job number, right? The economy added however many hundreds of thousands of jobs, and the president gets out there and goes, hey, everybody, everything is great. There's lots of jobs, and everybody thinks jobs. It's really good. But then that means that inflation goes up, and then interest rates go up because there's more people out there who are making money and have more buying power and are buying more things.
Right. And the thing to keep in mind is this is all speculative. This is just these people, the investors, and you keep in mind a lot of the investors are computer programs, that are investing money for people, that probably the majority of it. So they're set to make certain investments based off of what's going on in the world, right? So but let's get to the inflation bit, right, and how that relates to jobs. So the inflation numbers got really high, and that is what started to bring interest rates up, right? If we have inflation, it means that money is worth less. So if you're giving somebody a loan at 3% and inflation is at 5%, you're effectively losing money, right? So interest rates are going up in order to keep up with inflation. So the Federal Reserve is raising all of these rates. They're trying to slow down the economy by making it more expensive to borrow money, right? So you get your credit card bill, all of a sudden the interest that you are getting charged every month is twice as much as it was before, So the thought is that that's going to keep people from spending quite as much money. And it was starting to work. We're seeing the year-over-year inflation numbers start to come down. And another piece of this is that we're expecting at least the markets are expecting a recession, right? The Federal Reserve is trying to, they're trying to raise these rates. Ideally for them, they want to see inflation go down, the economy slow down a little bit, but not have the economy slow down so much that it causes a recession, which leads to job losses. And, it just means that the term recession means that as a whole, the nation is not we're losing money basically.
GDP is shrinking instead of growing.
That's right. That's right. So, and that reflects on everybody else, and that causes the stock market to go down. It's, it's all a big crazy machine. So the market, the investors are expecting that there's going to be a recession, right? That's sort of how it's looking.
And they've been saying there's going to be a recession for like 2 years now. It's always like there's a recession right around the corner. There's a recession right around the
and
corner.
the reason for that is that we had multiple quarters of negative GDP, which normally is enough for them to call it a recession. But the kicker is that the unemployment rate is really low. It's at 3.4, 3.5%. So they're saying like, well, we're not really in a recession because all these people are employed. That's the thought is for the Federal Reserve and the politicians is like, hey, if we can slow down the market but still keep people employed, that's an ideal situation. That's what they're calling a soft landing, if you've heard that in the news, right? That's what the Federal Reserve's goal is to achieve a soft landing on inflation, where they bring down the inflation without causing a recession. So none of the investors really believe that that's going to happen. It's thought to be incredibly unlikely. So what happened in January? Let me show you the chart really quick here.
Sure.
So share the screen. All right. So this chart here that we are on, this is the yield on the 10-year Treasury bond. All right. And this one is helpful because interest rates typically follow along with this index. So what we'll see here is that when this index is going, oh, sorry, scratch that. This is the wrong chart. This chart here is the yield on a 30-year fixed mortgage bond at 5.5%. So this is how much money that the banks make on a 30-year fixed mortgage at 5.5%. And you can see this is the yield. So 100 is 0. That means that's the break-even number, right? This is where we're at right now. So at 99, that means that the bank it costs them 1% of the loan amount to give out a loan at 5.5%. So what we're seeing here is that the actual interest rates that we're seeing are more like 7%. All right, that's what that means. You get up to here, this is February 2nd, and at this point the rates were 5.75, 5.5%. Right? And at that point the yield was almost 2% on a 30-year fixed at 5.5%. So
right,
if the banks are making 2%, they're willing to give you a loan at 5.5%. Right? That's essentially how that works. So we were talking about the jobs report that came out, and that's really what flipped the interest rates and started things going the wrong direction. So this is the day right here, I believe, February 3rd, when maybe this is probably the jobs report on the 2nd, and then the 3rd is when it really sunk in and hit. So what happened is they released the job numbers. They get some early indicators. There's ADP, which is a huge payroll company. They have millions of people that they do payroll for. Yeah, and so they have an estimate of how many job gains and losses we're going to have. So they were estimating that we were going to gain 120,000 jobs or something. That was kind of the expectation. So the Bureau of Labor Statistics comes out and releases their report the next day. And they say, hey, we gained 570,000 jobs. And that's when this happens, right? They're like,
Was that the number? Was that the number?
yeah, approximately 570,000
That's a
jobs.
huge number.
It's a huge difference, and it's fishy. And I'll tell you more
Well,
about
it's just
that.
a huge number. Like usually, you know, if you hear that the economy added 200 to 300,000 jobs, like that's pretty good,
That's really
right?
good. Yeah. Yeah.
Yeah. So to add that many,
To add $570,000 on an expectation of 100 or 570,000
right?
jobs on the expectation of 120, that's a big difference. And that needs to, it's when you need to kind of stop and question it. So one thing that happened is that a lot of those jobs were part-time jobs, right? It's reflecting
Sure.
the numbers. You know, you got Christmas workers and all that kind of stuff. So
Yeah.
lots of part-time jobs added. The other thing that's still, you know, you're still way over the expectation. And what happens is that in January of every year, they recalculate different adjustments they make to this unemployment rate. So they'll say, okay, we need to make a seasonal adjustment, right? So you get more jobs in at this time of the year than you do at this time of the year. So they try to make adjustments to make it all work. But one of the other ones they make is called a population control adjustment. And I don't know exactly how to explain that, but it has to do with immigration. It has to do with births and deaths and people leaving the workforce, and essentially the population of workers that we have overall. You know, that's what they're factoring. And so that population control number changed significantly. And that is why it was 570,000 jobs instead of the raw data, which was basically like zero jobs that were added. So that brought the unemployment rate down. And so what that indicates is like, wow, maybe we're not going to have a recession, you know, maybe. And if there's all these people who have work, the economy is probably not going to slow down as much as we expect it to, because people have jobs, so they have money, right? And so now the expectation is, well, I guess inflation's not coming down is going to come down as fast as we thought. So we better start raising the rates again. And that's what happened. So that's how this happened for the majority of this month. And let me just.
So for you, right? So all of this is like macro stuff, big level stuff that's just happening out there in the economy. Obviously, like you have zero control over any of this, right? You're just sort of watching it, keeping an eye on it because it informs you as a mortgage broker. So in your sort of day-to-day work of helping people qualify for mortgages, get approved, refinance their homes, you know, do all of the financing required in the, you know, residential real estate space, how does this affect like your day-to-day beyond just like understanding like what the mortgage rate is today?
You know, it gives me a sense as to, I mean, you know, I can look up the interest rates and see where they're at, but this
Right.
gives me a sense of what's happening. And, you know, and I follow analysts. There's an analyst connected with that website who is much better at looking at the markets and figuring out what's going to happen, and how the things that are going on in the economy, you know, if there's a Federal Reserve meeting, that always makes a big difference because they're going to make some comments. They're going to change the way investors think. If there's an unemployment report coming out or an inflation report coming out, all that stuff, you know, that's the kind of thing that they forecast. And so really when it comes, you know, this is just a big help in determining like, okay, this is where the rates are going. This is what we expect. So for example, and when it comes down to it, we have the option to, when you go to buy a house, right, you get your loan started. We go into the process, we open escrow. Now I can lock your interest rate as soon as we have the accepted contract. And we'll lock that in. It'll be set for 30 days. You know, if the rates get better or they get worse, it doesn't matter. You're locked into that rate. Now, if we wait, you know, in some cases, if it looks like,
hey, so you're locked in even if the rates get better? So
Now,
it's such a like, it's kind of like gambling.
totally, it's a total crapshoot. And that, I mean, it does help to have a knowledgeable mortgage broker who can
Who
watch these
understands
things.
like maybe the rates will be a little lower on this day, and this is when I should lock the rates. Because obviously, like we work together a lot, right? And
Mhm.
I've heard you say multiple times, like, all right, I'm gonna lock the rate here, or I want to wait a couple of days before I lock the rates because I think they're gonna come down a little bit.
Mhm.
And
Mhm.
on the realtor side of things, I'm not really thinking too much about like why, because I'm
Yeah.
thinking about other stuff, right? I'm
Mhm.
just sort of depending on you to get it right?
Right.
So that, then the client is happy. That's what we're looking for, right?
Right. Absolutely. Absolutely. And I mean, just to kind of put it in perspective, let me go back to that screen really quick. And this is not, it's not a perfect, put this back to the year. It's not, this is not like a perfect way to look at it, but effectively what this number is right here, this
Mhm.
is a yield. So let's say yesterday, this was 44 basis points less. And so what that means is that's 0.44% of the loan amount that the loan is going to cost. So we'll just say it was a 7% fixed rate loan. Yesterday, you would have had to pay 0.44% in points to get a 7% loan, whereas today, because it's gone up, you wouldn't pay anything for that same loan. And so if you're talking about like, that's 400 and it's going to be on $1 million. It would be like $4,400 on $1 million,
Mhm.
and that's out of pocket money that somebody's going to pay when they're buying a house. So that's why this is important. One day you can save somebody that much money just by holding off. Also, if you hold
Right.
off and you don't do it correctly, you can lose. So I always make sure to have that conversation with people and say, hey, this is kind of what we're expecting. This is what it's going to be. And the other thing is like, if it does get better, if it gets significantly better, what's great about working with a broker like myself is that I can always just pull your loan from one institution and bring it over to another institution and get you the current
Mhm.
day's rates.
Start over.
Yeah, yeah, and without it costing too much time. If you're going to Chase or wherever, a big bank.
You're locked into them.
Exactly, because they've got their one program. I'm working with dozens of banks, so that's just one little benefit of working with me rather than those guys. But
That's interesting. Like, I don't think a lot of people necessarily fully understand the difference between a mortgage broker and getting a mortgage from a bank,
mhm,
right? A lot of people obviously do understand that, but they might not know that you have the ability to essentially shop around for them, right?
right, yeah,
And
yeah.
find different, loan products at different rates, and essentially find the best thing for them and be in kind of control of that situation. Whereas if they, just go to, as you mentioned, Chase, and all of a sudden they're in the Chase system, that still might be a great way for them to go,
Mhm.
but
Yeah, I don't
they're not
necessarily
going to
want to
know they have
disparage
other options.
Chase either because I've
Right.
got some friends who work over there and sometimes they have things that I can't do. And I mean, I've even
Right.
sent people their way when they've got something that's a lot better. So that does happen, but but it's a flexibility. Like I said, I work with dozens of lenders. They do all different types of loans, and and it just makes it easier. And as a broker, another piece is that I work for the client. I don't work for the bank. So,
Right.
my for me, my number one priority, my number one goal is to make sure I'm taking care of my client. Whereas at the bank, their number one goal, if they work for the bank, is to take care of their bank, and get the best deal for the bank. So, um, just a couple of little reasons why I prefer to be a broker. I don't get
Right.
any benefits, which is a bummer, but whatever.
Yeah, but
uh,
you get to be a cowboy.
that's right. I get to be a cowboy. Uh, um, so yeah. So why don't we talk talk about selling homes and listing your home.
Sure. Yeah, I this week was at a meeting with a potential client, and when you're sitting down with somebody who wants to sell their house, right? You know, a lot of people understand or like have an idea of what it's like to buy a house and be in the position of the buyer, right? Um, but being in the position of the seller, it's so different in a lot of ways, right? You're selling something that's a huge asset, and you want to make sure that you are getting the best that you can get for that asset, right?
Yeah.
And there's so many factors that go into that, right? So in this particular case, as with everything that we were sort of just talking about as it relates to interest rates, timing is everything, right? If you were selling your house a year ago, a year and a half ago, when interest rates were low, and there were many buyers out there in the market who were competing with each other, just outbidding each other, going crazy and driving prices up on houses, it was a great time to sell your house, right? But if you missed that particular window, right, and even through not intentionally, right? So like in this particular case, the seller just had a sort of a stroke of bad luck that led them to hitting the market later than they originally intended to.
Right.
And now, they're facing a market where there's fewer buyers out there and interest rates are much higher, right? So the initial sort of return that they were projecting based off of the sale is now completely changed by the shift in the market, right?
Yeah.
And it's really important to, number one, be really, really thoughtful about, if you can, right? Because not everybody can. Some people are selling their house because they have to sell their house, right? And they don't really have a lot of control over when it hits the market. But if you're planning on selling it, be real thoughtful of the market conditions that you're in, because that's going to inform like what price you set for your house. Because a price that would have been appropriate in a market where interest rates were low and there were many, many buyers, right, may not be appropriate now.
Right.
And pricing the house too high is just going to cause it to sit there on the market for a long period of time. And you're going to have to go through price drops, and that's going to affect the whole perception of what the house is worth, right? Because buyers and agents, like if you're on the buyer side of things, we see a price drop and, we sort of smell blood in the water, right? Like, oh, okay, this house has been out there for a little while. Maybe they're getting a little desperate. Maybe this is an opportunity for us to be able to get an offer accepted at a lower price point, right? Which is, good for the buyer. But, as a seller, you always want to project a position of strength. So, a lot of tactics, and I'm sure like there's people out there who are really familiar with this. If they were trying to buy a house sometime in the last 2 years when rates were low, they'll see a house that comes onto the market, right, that is priced, maybe $100,000 below where they know that it should be, right? And people go like, is this right? Is this the real price? This looks like a house that should be priced at $1.5 million, but they're pricing it at 1.1 million. Why is that? Well, it's because now all these buyers are going to get really excited about that property, and they're going to get a swarm of people out there, and they're going to create a bidding war, right? And agents are doing that intentionally, super intentionally, because they're looking for that effect, so that then people start outbidding each other and get really excited, and they can drive up the price, which is a win for their seller.
It only makes sense, right? Once you want something, and then they tell you can't have it unless you pay more for it, and it's a house. You all of a sudden walked in there and you see yourself raising your family there and living there for a long time and how you're going to decorate it and all those things, it makes people much more likely to stick with it and keep bringing the price up. And it is hands down the best way to sell a house in any market is to look at the other homes that are on the market that are similar to yours and price it for less than those ones.
Mm-hmm.
It,
On the flip side, if you price it too high, right, like way too high, then you're not going to get that many people going to look at it,
right.
and you're not going to create that effect. And people are going to go into that house. The people that do go are going to go into it with a completely different perception
Right.
of what this house is worth. Like it's really interesting. I always advise people, to try to not be emotional is not quite the right word, because of course there's going to be emotion involved, but to not look at it as like an overly adversarial kind of situation.
Yeah.
Like the buyer is a person, the seller is a person, and at the end of the day they're just trying to get the best deal for themselves, right?
Mhm.
They're just trying to work in their own best interest. It's
Well,
just rational.
and that's good advice. And I think when you go back to the fact that it's just two people who, want the best deal, I think a lot of people, they're not looking to get over on each other. They just want a fair transaction.
Right.
They want a fair price, and the buyers want a fair price, and the sellers want a fair price. And the idea is to meet in the middle where everybody feels like they've come out a winner.
Right.
There's not always a winner and a loser, not in this kind of a thing.
Yeah, but if you list your house too high, like 20% over where it really should be, 10 to 20% over to where it really should be, then that creates an effect in the mind of a buyer of like, oh, well, this person's just trying to gouge me,
Mm-hmm, mm-hmm.
like who do they think they are,
Yeah.
um and that's not really even the intention of the seller at all, right? Like their intention is like they just really believe that this house is worth that much money because they put all this work into it. They've got this really strong emotional connection to it. They believe that if they put it out there, then that's what they're going to get, right?
Right.
But
Or at least, make me an offer. That's
mhm,
okay. We'll put it up at this price. Maybe we only think we're going to get this, but sometimes that's the thought process. Like, oh well, if we price it here, we should at least get to here. And
but it never really works that way.
it doesn't work that way. That's a flawed way of looking
No.
at it. At least, yeah,
Yeah.
not definitely not with a house.
Yeah, it never really works out that way. I've never really seen it work out that way. It usually just creates this situation where it turns people off, and you don't get the kind of traffic that you really need to drive up the price to where it is that you want it to go.
Mhm.
And it can be really, really challenging trying to convince somebody that that's not the way to go, because people are people, right? Like everybody's
Mhm.
got, maybe they've been successful doing that before, or maybe they've heard a story of somebody who was successful of doing that before, and now they've got that
Well,
idea in their head where it's like that's going to work again for
well,
sure.
I think also you mentioned the emotional attachment, and if you owned a
Hmm.
home and taken care of it and poured money
Hmm.
into it, and cleaned it every week, and
Yep.
just all the things, you're gonna value it in a high manner.
Yeah. It's one of, as the agent side of things, the realtor side of things, one of the most challenging things for us is to communicate to people um the truth about things, like just reality, right? um while they are navigating just so many emotional things that are a part of this very emotional process for them, right?
Mhm.
You know, like they're attached to this house, their family is attached to this house, right? Maybe they have a spouse who, you know, feels a certain way about things, and you know that all like matters, right? It's all really important. You don't make any, nobody gets a deal done unless everybody agrees,
Right.
right? You've got to like come to that agreement. So like part of our job is like not being afraid to tell people the truth, you know,
Mhm.
because there's a lot of agents out there who will tell people what they want to hear,
Right.
right? Who will
Right.
tell people like, yeah, you know what? For you, your house will get that much money. You should list it right up there. It'll get that much money, and you should give me the listing, and I can get it for you.
Right. 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 Well, I think, or just like, well, I don't know, it's worth a shot. We'll give it, thinking like, hey, let's just get this listing, and then, if I
Right,
gotta talk them down later, at least, we're under contract or whatnot. So
you're right. Yeah, I don't do that.
it's a
I
waste of
tell
time.
people, I tell people, you know, what I believe the truth to be, you know, and I think like that's sort of the best thing we can do as, you know, agents and as a mortgage broker, right? Like you've got to be straight up with people, and allow them to make the decision, right? If they want to, you know, go in a different way, then that's up to them, right? It's their choice to make, but it's our job to present the best information as we see it, you know, and try to get it right. Like as you were saying, with all of that data that you're looking at, there's a reason why you're looking at that data, right? So that you
Mhm.
can, you know, time those things correctly so that you can get the best outcome for your client, right? The same way, like on the agent side, there's a reason why we're, you know, not going to make a recommendation to you until we've done our diligence and we've looked at the market and we've run comps and we've done analysis and we really like, you know, feel confident about what that recommendation, what that price should be. And then it's, you know, it's up to the client. It's up to that person to then, you know, either go with that information or not to and go in a different route.
Mhm.
And, you know, you see that out there in the day to day when you are, you know, you see these houses that have been sitting on the market for 60 days, 90 days. They've dropped the price once, they've dropped the price two times. And, you know, sometimes there's other reasons for it. But once you've been looking long enough, even, you know, not, you don't even have to be a real estate professional. You can just be somebody who's, you know, a buyer. Like people get savvy to like, they priced that house too high. And now they're,
Sure, sure. All you have to do is look on the internet and look at the listings and say, okay, this one is $1 million and this one's $1 million. Which one is better? And if one's clearly better, then
right,
know that the other one is overpriced. That's it's not that hard. It's not rocket science.
right.
Um, Another thing too for sellers, if you put it on the market and put it a little bit lower than you want, you don't have to accept the offer, even if it's the offer that
Right.
you put it up there for. Even if you're
That's
expecting to
right.
get more money, you still don't have to take that. Uh,
Yes.
you know, so it's but it's frustrating for buyers too. I mean, I want to acknowledge a lot of people that I know who went through this in the past few years where they were trying to buy a house and they would see something and they would get super excited and then it wouldn't, they would get outbid by $200,000 because
Yep.
the house was underpriced and the market was really hot.
Yep.
So it's a real bummer. As a buyer, you need to understand that that price doesn't really mean anything. And as a seller as well, the seller too. It's not like you're buying a loaf of bread. This every house is different for the most part, and
Yep.
there's never going to be. I mean, unless you're buying in a track home community where they're exactly the same and they're brand new. There's I mean, sometimes even with condos, you can get the same model and all of that. But for the most part, everyone's a little bit different and has a little more appeal or a little less appeal than another one. And it's one of those things in our world, one of the few things in our world that's truly negotiable.
Yeah, 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 yeah. With that, I just kind of want to finish here on this one thought. And that is, the idea of people either being insulting or being insulted by offers, right? You'll hear this all the time, right? Where an offer is made, let's say a house is priced at $2 million and somebody makes an offer at 1.8, right? And then, on the agent side, I always tell people, unless it's just like totally crazy, if we're like sort of in the ballpark, like you can always counter that. Like it's a real offer. Somebody is, signing a paper that says that they will pay you, in this particular scenario, right, $1.8 million. That is not nothing, right? And you now have the opportunity to, say, well, you could be insulted by this, and say, I'm not even going to respond to that, or you can counter back at the price that you want. If you want, 2.2 million 50, right? Then you can counter back at 2,000,050. And if you're in that situation where now they've written an offer and you now have countered the offer, right? Now you're in a real contractual negotiation where there's a real opportunity there to make a deal.
Yeah.
You're much closer in that space to making a deal than you are when there's no offer on the table. Somebody actually writing an offer that's in the general ballpark is a lot better than not having anything. And
Right.
and
even if it's not in the
about it,
general
not
ballpark,
responding.
all you got to do is say no.
For sure. First, yeah, for sure. It's just that idea of like taking it personally, like these people don't even really know you, right? So it can't really be personal in that way. It might feel that way. And I'm not telling people, to not feel the way that they feel. You're going to feel how you feel about things. Like that's, okay. But at the end of the day, real estate works like a game, and you're just trying to win, right? And the best way to win is to sort of try, if you can, to detach yourself from some of those emotions sometimes and just work to make the best decision that you can make. Because quite often, if you can do that, you'll come out to a really good outcome.
Yeah. No, that's a great point. And we certainly see that a lot where people feel offended or just get really caught up in the situation. And that's one thing that makes for a good real estate agent, is the ability to help people pause and put everything in perspective, and also present these things in a way that's that's not going to fan those flames.
Right, yeah, if the agent is getting offended.
Some agents, it's like it's like, let's make this as crazy and emotional and into this roller coaster kind of a drama. And it's very common. It's definitely a normal,
everybody, we're all just people.
Yeah.
Like there's we would love for it to be like this super clean process where it's like really straightforward and easy, and it can be sometimes it is. Sometimes we get these deals and they are boom, and everybody's like, oh wow, that was great.
Right. Well, you have to
more the exception than the norm.
Well, yeah, you also have to consider that most people who are buying a home or selling a home don't buy or sell homes for a living and don't do it very often, so it's a high stakes kind of thing. And whatever you're an expert in, you're an expert in, but we're the experts in buying and selling homes, and you have to establish enough trust with the clients and for them to trust you, that you're being honest with them and giving them good information and trying to help them understand that there's nothing to be offended about. This is simply a business transaction. Figure out what you want and what you're willing to do, and you can say yes, you can say no. That's what it is. We all have a choice in the matter.
That's right.
Yeah. That's good. I like that topic. That's a fun one because it is definitely a regular thing. All right. Final thoughts. I've got one piece of good news in the mortgage world, even though the rates are going up right now. The FHA, if you're not familiar with the FHA, it's a government-backed loan program where they put it out there to try and help people buy homes who don't have very much money to put down or who maybe don't have great credit. They also allow for a higher debt to income ratio. So if you don't make as much money, you're more likely to qualify. Well, FHA in the past has had this mortgage insurance that's very high. They still have the mortgage insurance, but they have reduced it pretty significantly. So, and their rates are always a little bit lower than conventional loans. So I'm finding now that most of the FHA, the loans that I'm pricing, the FHA loans are, the payments are either lower or they're similar to conventional loans, which is big.
That's great.
That means
Yeah.
if you have a 670 credit score, you can get the same kind of payment as somebody who's got a 760 credit score.
And
So-
you don't have to put down 20%.
Correct. Well, you don't need to put down 20% on a conventional loan, but yeah, FHA 3.5% down for a first-time home buyer.
Yeah.
It's a great option, and that's good news. That's definitely good news. It hopefully will open some doors for some people.
Cool. Well, that's all I got.
All right, me too. Yeah, have a good weekend. Woo!
See y'all next time. Yeehaw.
Yeah. Adios.
Bye.